Hi everyone, Tracy here. I'm reviewing Chapter 6, Question 9a. And the first part of the question was to calculate the average cost of each unit. So the question is, Sarasota Corp began operations on July 1st. It uses a perpetual inventory system. During July, the company had the following purchases and sales, and they're all listed right here. So what I did was I took this into Excel because that was the easiest way for me to calculate it. Here at the top, I just carried over the information from the question so that I had it all on one sheet. And then this is the part where we actually work out the problem. So the first thing we have to do is calculate the average cost. So on July 1st, to calculate the total cost, we have to calculate the total cost of the first purchase and the average cost per unit. So we know that we bought 13 units. We paid $116 each. So our total cost per unit is $1,508 with an average cost of $116. On July 6th, we sold 9 units at an average cost of $116. So we have our 9 units at $116. We have to calculate the number of units left in inventory and the total cost of the inventory. So what I did was, right here, we started with 13 units. We subtracted 9 units, so we have 4 units left. And 4 units at $116 gives us $464. On July 11th, we purchased 6 units at a cost of $123 per unit. So we have our 6 units, $123 per unit, gives us a total cost of $738. Now we can't use this original average cost because we bought new inventory at a higher price. So we have to calculate a new average cost per unit. So in order to do this, we add the number of items purchased to the inventory and add the total cost to the previous amount. So we've added our 4 units that we had in inventory plus the 6 units that we just bought gives us 10 units total. And we took the total cost of $464 for our 4 units that we had left, plus the amount that we paid for the 6 that we purchased of $738, which gives us a new total cost of $1,202. So to get our new average cost, we take our total cost and we divide it by 10, which is right here, gives us $120.20 average cost per unit. On July 14th, we sold 6 units at an average cost of $120 per unit. So we have 6 units that we sold at an average cost of 120 units. So to calculate, we have to calculate the number of units left in inventory. So we had 10 units, we sold 6, we have 4 left. And 4 at an average cost of $120.20 gives us a total cost of $480.80. And our average cost is still $120.20. On July 21st, we purchased 7 units at a cost of $133 per unit. So we have 7 units at $133 each, gives us $931 total cost. So now to calculate again our new average cost per unit, we have to take the 4 that we had in stock, add 7, which gives us a total of 11 units. At a total cost, we take the cost of the 4 that we had, $480.80. We add the new total cost from the 7 that we purchased, $931. gives us a new total cost of $1,411.80. And a new average cost, we take our total cost divided by units, gives us an average cost of $128.35. On July 27th, we sell 6 units at an average cost of $128.35 per unit. You'll see here that the average cost stays the same through 2 transactions. That's because it will only change when we purchase new items. So it will stay at that average total cost until we purchase new items. So if we go back over here to the problem in our homework, and we scroll down, we can see that the answers that we calculated are correct. The next part of this question says, determine the ending inventory under a perpetual inventory system using FIFO, moving average, and LIFO. So again, I took it to Excel. So we're using the same information that we had up here originally with the items that we purchased and the sales that we made. So FIFO, to determine the ending inventory under perpetual inventory system using first in, first out. On July 1st, we purchased 13 units at $116 per unit, which gives us a balance of $1,508. Then on July 6th, we sell 9 units at $116 per unit because this is the cost at the time. So we have 9 units at $116. The total for this transaction is a cost of goods of $1,044, which gives us our new balance at $464. And this leaves us with 4 units in stock. On July 11th, we purchased 6 units at $123 per unit. So we have 6 units, $123 per unit. Our total transaction is $738, and our balance forward is the $464 plus the $738 gives us $1,202. And we now have 10 units in stock. We have 4 in stock at the price of $116, and we have 6 in stock at the price of $123 per unit. On July 14th, we sell 6 units. And because we're using first in, first out, we sell 4 units at $116 and 2 units at $123, which is this calculation right here. And the reason we do that is because we have to know that how many we're selling at each price that they were brought in at. So that's why we calculated how many we have in stock during each transaction. So the 4 at $116 comes to $464. The 2 at $123 comes in at $246 for a total cost of goods sold at $710, which now brings our balance to $492. And we have 4 units left in stock at $123 per unit. On July 21st, we purchased 7 units at $133. So 7 units at $133 gives us a total transaction of $931 and a balance of $1,423. On July 27th, we sell 6 units. And because we're using FIFO, we sell 4 units at $123 and 2 units at $133. That is because of the units that we purchased at $123, we only have 4 of them left in stock. So we sell those 4 first, and then we add 2 to them from the 7 that we've purchased. So 4 at $123 is $492, and 2 at $133 is $266, with a total transaction of $758. We deduct that $758 from our balance of $1,423. Our ending inventory is $665. To calculate it using last in, first out, we purchased 13 units at $116 per unit, which gives us a balance of $1,508. We sell 9 units at $116 per unit because this is the cost at the time. So we sell 9 units at $116, gives us a transaction of $1,044 and a balance of $464. On July 11th, we purchased 6 units at $123. So 6 units at $123 gives us a total transaction of $738, and we add that to our balance of $464, which gives us $1,202. On July 14th, we sell 6 units. Because we're using LIFO, we sell 6 units at $123. Because we sell the last items we purchased first. So we're selling these 6 items that we purchased right here. So 6 items at $123. $738 is the total transaction, which we deduct from our balance, which leaves us $464. On July 21st, we purchased 7 units at $133 per unit. So 7 at $133 gives us a transaction of $931. Added to our previous balance gives us a total of $1,395. On July 27th, we sell 6 units. And because we're using LIFO, we sell them at the last purchase price, which is $133. And we purchased 7 of them. We're only selling 6 of them. So we sell 6 at $133, gives us a transaction of $798. Subtracted from our previous balance gives us an ending inventory of $597. To calculate our ending inventory for our moving average, I went back to my original calculation of my average cost per unit, and I used those numbers in my calculation here. So we purchased 13 units at $116. We get our balance. We sold 9 units at $116. We get a transaction total of $1,044, which we deduct from our balance to get $464. We just continue to do this all the way down, calculating our transactions and subtracting them from the previous balance, which leaves us with an ending inventory of $641.70. And if we go back over here to the problem in our homework, we can see that our ending inventories are calculated correctly. The last question was, which costing method produces the highest ending inventory valuation? And if we go back up here, we look at FIFO is $665, moving average is $642, LIFO is $597. So our highest cost method so the method that produces the highest ending inventory valuation is FIFO, which is correct right here. This question was really troublesome to me, so I hope that I broke it down clearly, that you could understand it. And if any of you would like a copy of the Excel spreadsheet so that you can review it with your study notes, I'd be glad to send it to you. Thanks, everyone.